Hi, welcome to On the Investor's Minds. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management. And thank you for giving us a few minutes of your time to learn about what investors are thinking about right now and how that fits in with your portfolio construction. Since the start of the year, we've had a number of surprises. I think one of them is actually European equities. If you look at MSCI Europe, it's up year to date, 7.7% at the time of recording. Compare that to S&P 500, which is down 4.5%, and amongst which Germany, the DAX index, is up 14%. So I'm delighted to be joined by Regina Liu, who is our APAC Head of Investment Specialist for the International Equities Group, who share with us some of her observations on European equities, where is it going to go from here, and how that fits in with our investors' portfolio. So Regina, welcome to this podcast.
Thank you very much, Tai.
So now in the context of European equities, as I mentioned earlier, it's been outperforming the US. I think that's a nice surprise. What are some of the key factors driving this trend?
You're right, Tai. Who would have known European equities outperforming the S&P 500 year to date by 12% in dollar terms? It is probably worthwhile to note that Europe equities has been a very unloved asset class, or I guess from an equity standpoint, is very unloved region. If you look at since the global financial crisis, a net outflow of $400 billion have actually gone out from Europe equities. You had a lot of volatility around Brexit, etc. And the market generally was just very, very cheaply valued from a valuation standpoint versus the US equities market. But obviously, valuation is not enough alone as a factor to drive sort of what's going on today. We do think that one of the major catalysts in the shorter term has been the progress on the potential ceasefire in Ukraine. We do actually feel that the rebuilding of Ukraine would be contributed by mainly European companies, which generally, a lot of the industrial production, a lot of the purchasing power, etc. Those things coming through from European consumers, etc. is something that's going to be driving this whole trend a little bit of the shorter term. However, I think what's more important is that investors are also starting to appreciate the diversification benefits of investing in Europe. If you have been overweighting in the US or a lot of the structural, longer term themes such as artificial intelligence, data centers, electrifications, etc., adding European equities to the portfolio to some extent is a strong diversifier. So if you do look at some of the more volatile market events over the course of the last couple of months, if you think about the DeepSeek Monday, if you will, the US was down about 150 basis points, where Europe has broadly been flat. So that just brings through that diversification benefit to a lot of clients' mind at the forefront. When you couple that with the historic discount of Europe versus US equities, that just have sort of come along as something that we feel like Europe is seeing off to a fast start in 2025.
So I think that's really interesting because obviously US and Europe, as you rightly mentioned, is a very sharp contrast in terms of valuations, in terms of at least the perception of economic dynamism. But right now, I think what Europe is offering is not only good valuations or attractive valuations, but also more policy consistency, which is, I think, is appreciated now. And the other point is that there seems to be a lot more willingness to spend on national defense, on renewable, et cetera, et cetera. So while the US has been driving a lot of the global growth in the past few years, I think there's some questions now raised about the sustainability of that US growth momentum. I would say we're still reasonably constructive, but I think there's a bit more upside surprises coming out from Europe right now. So I think with European equities increasingly adopting buybacks and offering higher dividend yields, especially against US companies, how does that impact or influence investor behavior, and what potential long-term impacts could this have on the European markets?
Sure. As you said, Europe is historically the highest yielding equity market, particularly when you compare that to the US. So generally, you're seeing sort of 3 to 4% dividend yield organically just coming out from European companies. But one thing that's worthwhile to highlight is that the buyback yield in Europe is now actually higher than the US, which is somewhat surprising. It has actually been saying that a lot of the management or the CEOs of the European companies are actually now seeing much higher level of confidence in their own company, and therefore reflecting it in that buyback yield that we're seeing in Europe. So we do feel that, with that sort of increasingly attractive fundamentals that we said, the policy consistency, some of the geopolitical risks, hopefully now starting to sort of, unfolds itself in a way that provides a little bit more visibility. Investors who start to look at yield as something, as a buffer given today's market volatility, could see European equities as another strong reason to add. So I am with you in the sense that if investors are looking out for a little bit more of that dividend yield payout, wanting a little bit more of that little bit of a buffer certainty, we do actually feel like European equities is an area to find it as a diversification to the overall equity portfolio.
Yeah, no, I think this is something also we've been highlighting for quite some time, is that when you have greater market volatilities, especially coming out of the US, that income component is actually really appreciated, because obviously traditionally you get this from fixed income. But at the same time, I think increasingly stock dividends, especially coming out from Europe, that's more consistent, that provides, as you rightly said, with a buffer. I think that is super helpful in a world where policy uncertainties and confusion is creating market volatilities. So I think in the last 12, 18 months, we've heard a number of challenges facing the European economy and specific sectors. I think the most frequently quoted sector is probably the car sector, the automobile sector for Europe, where it is facing a lot of challenges, both from the Chinese electric vehicle makers, but also some of the regulatory changes that's taking place in Europe when it comes to replacing internal combustion engines. But from your perspective, which particular sectors in Europe are you focusing on, and which are the ones that you'll be more cautious about?
Sure, Tai. You've rightly pointed out that the auto sector is probably one of the sectors that we're a little bit more nervous on. And it's probably worthwhile to also highlight, which is the reason why we continue to feel like being active in the equity market is very important, just because not every sector is built the same way and not every company is built the same way. We are concerned about the current level of the inventories, especially in the auto space. The impact that it might have in terms of the future demand, and obviously a little bit of, ongoing price war, if you will, in China, just because, the Chinese companies are now actually building very attractive products in the EV space at a fraction of the price to their Western peers. And also concern on the ROE of the capex and the EVs that could be a little bit too low given the cost advantage coming through from China. So we are a little bit nervous in that particular front. Which is an area that we're shying a little bit away from. But I would call out that there are some very attractive sectors within Europe as well that we're focusing on. We're a lot more excited about European banks, not the most conventional area where you would find exciting, but it has been a trade that has actually worked incredibly well over the last few years. I'm sure a lot of you is going to be surprised to find it a surprise that since 2020 November, which is sort of where the Pfizer vaccine came out for COVID, European banks have actually outperformed MAX 7 since then. The European banking sector has actually been extremely well capitalized, especially the banks has been, over the course of the last, 15 years or so, when the interest rates environment was extremely low. A lot of the European banks have lost a lot of its profitability, earnings power, losing their bread and butter around sort of loan growth and deposits growth. However, as the interest rates market normalize, the access capital for banks have actually been looking extremely positive. And we're seeing European banks, having gone through a pretty challenging period, has now actually come out to be much higher quality than previously. Their ROE is actually higher than US banks, but European banks are still trading at about a 40% discount to their US peers. So we do actually find some of the sectors very exciting in Europe, but again, we would be cautious that not every single sector are the same.
Yeah, no, I did notice that the banks have done incredibly well, not just from 2020, but really all the way through the last few years. And I think as you rightly said, active management is really key in identifying some of the opportunities, but also being aware of some of the risks and potential pitfalls in any markets, not just in Europe. So in Europe, we talk about sectors. In the US, we often talk about tech and growth being the long-term drivers, which I still agree with. But if I look at Europe, are there any particular styles that you recommend for investing in Europe? Whether we spoke about valuation being still very attractive vis-a-vis the US. You spoke about high dividend play in Europe. Obviously, there are some high-quality companies that don't necessarily just benefit from the domestic economy within Europe, but they have a strong competitive edge across the world. So what would be your recommendation when it comes to the stylistics, when it comes to investing in Europe?
Yeah, when it comes to, I guess at the end of the day, when it comes to investing in equities, we continue to believe that being active, know the company that you're investing into, understanding the bottom-up fundamentals is something that's very important. So at the end of the day, I do actually feel like, just having that extra diversification outside of a US equity portfolio into Europe is ultimately something that is beneficiary to a longer term investment portfolio, given valuations, given the catalyst that we're seeing and has been discussing. But at the end of the day, I think Europe, being the highest yielding region in the world, to some extent, I do actually feel like, playing that dividend play, particularly, across, construction, chemicals, financials sectors, are probably some of the largest beneficiaries, especially if the Ukraine peace does come through. So, and European income styles generally is probably one of the better ways in terms of, having that slight value tilt as well that's built in inherently, especially if you sort of just put it side by side with a potential overweight in US equities or a growth portfolio. So it is about sort of how you complement your overall investment portfolio, but perhaps dividend or income is something that I would think would make sense.
Regina, thank you so much for sharing your thoughts on the European markets. I think, as we mentioned at the start of the year, diversification geographically and by sector is very important in 2025, where there are a lot of policy uncertainties, a lot of geopolitical uncertainties. While Europe may be somewhat of a overlooked markets for a lot of APAC investors, definitely I think it's time to revisit this value proposition or this investment proposition and have that as part of the overall portfolio construction. So Regina, thanks for your time and hope you can join us again very soon.
Thank you.
So thanks for listening. I hope you found this useful. If you do, please share this with your friends and colleagues and also consider subscribing. If you have any questions, feel free to reach out to your JP Morgan Asset Management client advisors and they'll reach out to us for the next episode. I'm Tai Hui. I'll see you next time to discuss what's on the investors' minds.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks, The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase and Company and its affiliates worldwide.